Welcome back to Iron Financial, everyone. I'm your lead analyst, and as always, I've got our resident market skeptic right here alongside me. Today, we're bringing you a raw, completely unfiltered explainer on CoreWeave's Q2 2026 earnings. We're literally stepping right into the foundry today to run a heavy-duty structural stress test on one of the absolute most explosive names in AI infrastructure. Listen, our entire mission here is to help you forge a much stronger portfolio and cut right through all the market weakness with pure, unyielding financial analysis. So before we fire up the furnaces, make sure you're subscribed to Iron Financial and go ahead and hit that notification bell. We have a massively dense earnings report to unpack today. We need to figure out right now if the load-bearing capacity of CoreWeave's balance sheet can actually support its hypergrowth scaffolding, or if the sheer capital intensity is going to crack the foundation. Let's get right into the numbers.
Okay, let's start by putting the sheer, unbelievable scale of this operation right on the anvil. We are looking at a gargantuan $104.2 billion revenue backlog. Just pause and think about the gravity of that number for a second in the context of AI infrastructure. That's an explosive 246% year-over-year increase. It represents practically guaranteed future cash flows, assuming they can simply deliver the compute. And you know what? That backlog figure doesn't even include the more than $25 billion of net new customer commitments they just added in the first few weeks of Q3 alone. But as we always say, heavy growth requires extremely heavy lifting. We have to pit that $104.2 billion backlog directly against a frankly staggering $35 billion to $39 billion capital expenditure bill that's been guided for full year 2026. This right here, this comparison, is the ultimate structural stress test. The real question is, can a company physically construct and power the infrastructure fast enough to monetize a $100 billion backlog, or is it going to just melt down under the extreme heat of its own capital intensity?
All right, moving into Section 1, Forging the Growth Engine.
To see if the metal they are pouring is actually generating true operational momentum, we need to look at the raw top-line power. For Q2, CoreWeave hammered out a massive $2.575 billion in revenue. That is a 112% year-over-year surge and a really solid 24% growth quarter-over-quarter. Compounding 24% growth on a multi-billion-dollar base requires immense structural integrity. But what's absolutely crucial for your portfolio analysis here is the underlying supply and demand dynamic that's underwriting these figures. Management was crystal clear on this point. Their near-term capacity is effectively sold out. There are literally multiple enterprise customers aggressively competing for every single GPU that CoreWeave manages to bring online. This isn't just passive, accidental growth. This is a demand environment that allows a company to completely dictate terms, handpick the highest margin enterprise clients, and forge a massive backlog into cast iron reality.
Now here's where things get really interesting. We have to see how this scale is finally starting to forge real operating leverage. This was actually a huge concern for investors previously. Could they actually grow without constantly diluting their margins? Well, just look at the quarter-over-quarter leap. In Q1, adjusted operating income was just $21 million, which was grinding out a pretty razor-thin 1% margin. But in a single quarter, that operating income absolutely rocketed to $128 million, representing a 5% adjusted operating margin. The scale is finally starting to translate into serious leverage. You see, when you build massive data centers, your fixed costs are immense. It's heavy upfront capital. But once those fixed costs are fully absorbed, every additional dollar of revenue falls so much heavier to the bottom line. The heat in the foundry is definitely rising, and CoreWeave is proving they can actually manufacture profitability from these massive hardware deployments. And we can reinforce the load-bearing capacity of these operations even further by looking at the adjusted EBITDA. CoreWeave delivered a colossal adjusted EBITDA of $1.51 billion in Q2. That represents a staggering 59% margin. When you are doubling your adjusted EBITDA year over year while somehow maintaining margins near 60%, you are laying down serious, high-grade rebar into your financial foundation. High-performance AI compute operates almost like premium digital real estate, and CoreWeave is basically collecting penthouse rent. It really shows that despite the heavy upfront capital outlays to build these data centers out, the core unit economics of renting out high-performance AI compute at scale are deeply, structurally sound once you finally get the power switched on. And on top of that, they're actively welding a massive pricing moat to protect those margins. So a crucial point to remember is that in July, CoreWeave executed a roughly 25% price increase across its SKUs. And get this, that massive price hike wasn't even included in the Q2 margin expansion we just reviewed. That's all upcoming upside. Furthermore, as they deploy next-gen silicon like NVIDIA's Vera Rubin, they are seeing contribution margins jump 5 to 10 percentage points higher right off the bat, simply because clients are willing to pay an absolute premium for cutting-edge speed. And even more incredibly, which is a total shock to anyone used to typical tech hardware depreciation, their prior generation GPUs like the A100s from way back in 2020 are retaining peak pricing power. They are signing contracts on those old chips all the way out to 2029. Demand is so significantly exceeding supply that it gives CoreWeave the ultimate leverage to just pass through any component cost increases directly down to the customer.
All right, but here is where our resident market skeptic is going to step in and raise a hand. The skeptic's view is this. You've painted a really beautiful picture of a hypergrowth engine, lead analyst, but when you look closely at the blueprints, there are some massive red flags waving. The core question we absolutely must answer for any cautious investor is this. Does this operating leverage actually grow fast enough to outrun the terrifying accelerating interest costs? Or is this entire hypergrowth scaffolding just going to collapse completely under the crushing weight of its own debt?
And that brings us to Section 2, stress testing the debt.
The skeptic says it's time to apply maximum hydraulic pressure to the cracks in CoreWeave's balance sheet. We simply cannot responsibly do this explainer without stress testing the massive capital sinkhole that makes this whole operation possible. Let's talk about the raw burn rate. In Q2 alone, CoreWeave burned through a massive $9.4 billion in capital expenditures. They added nearly 500 megawatts of active power in a single quarter. To put that into perspective, that is literally enough to power a medium-sized city built entirely from scratch in 3 months. Yes, they are building exceptionally fast, but the physical requirements are astronomically expensive. Buying the land, securing massive power transformers, building the physical structural shells, installing complex liquid cooling systems, and filling them with tens of thousands of cutting-edge GPUs, a $9.4 billion quarterly Capex bill is a staggering load to bear, and it requires constant, heavy-duty financing just to sustain it.
And here is the maximum shock value for your portfolio. To fund all that Capex, they are taking on massive amounts of debt, and the interest is compounding fast. Over the first 6 months of the year, they paid $985 million in interest expense. In Q2 alone, net interest expense was $640 million. But brace yourself, look at the guidance for Q3. Their expected interest expense is jumping to between $860 million and $940 million for a single quarter. Nearly $1 billion in 3 months just to service the debt. That translates to an annualized run rate of almost $4 billion in pure interest. That is a massive structural threat to bottom-line profitability if top-line revenue ever skips even a single beat.
And the raw GAAP consolidated statements of operations brilliantly illustrate the harsh reality of those exact interest burdens. The truth is laid bare right there on the income statement. Heavy operating expenses and the sheer crushing gravity of equipment depreciation are driving a $1.366 billion year-to-date net loss. Now sure, depreciation is technically a non-cash expense, but it still heavily weighs on GAAP profitability. When you pair that massive net loss with a staggering $35.55 billion in principal debt sitting ominously on the balance sheet, you really have to ask yourself, can this foundation actually withstand a sudden market shock? If AI demand softens even slightly, this high-leverage metal is going to snap. Okay, lead analysts stepping back in to counterpunch that argument. While the skepticism regarding the $35.55 billion in principal debt is absolutely warranted, it's a massive number. We cannot ignore the heavy-duty shock absorbers CoreWeave has purposely bolted onto this frame. They are sitting on over $6.9 billion in cash, restricted cash, and marketable securities, providing immense near-term liquidity. Furthermore, you really have to look at how smartly they manage this debt. Over the past year, they've actively reduced their weighted average cost of debt by almost 300 basis points. When you are dealing with tens of billions in principal, shaving 300 basis points off your interest rate saves roughly $1.1 billion in annualized interest based on their Q2 load. This isn't just reckless borrowing, it's heavily fortified, asset-level debt that is fully backed by guaranteed customer prepayments. And the core reason they can confidently underwrite that debt is their ironclad physical infrastructure roadmap. They ended Q2 with 1.5 gigawatts of active power. They've actually raised their full-year guidance to blast past 1.85 gigawatts. But even more importantly, their contracted power sits at 4.2 gigawatts, with a very clear strategic pathway to hit 8 gigawatts of active power by 2030. In the AI foundry, power is the ultimate currency. Controlling this massive pipeline of 8 gigawatts isn't just owning a physical asset. It provides structural, undeniable proof of future cash flows, acting as collateral that virtually ensures the debt load can be serviced. Competitors simply cannot match this pipeline because the grid capacity is essentially tapped out in key regions right now.
So, let's look at Section 3, Welding the Enterprise Pivot.
Let's see how all this builds into their broader strategy by looking at the flexible joints in the architecture. We're talking about adaptability here, how CoreWeave bends without breaking to capture maximum enterprise value. The most explosive pivot is happening right now in managed inference. Just look at this timeline. Booked annual recurring revenue for managed inference literally exploded from roughly $1 million to over $100 million in a single quarter. They are now targeting over $250 million by year-end. This is crucial, guys, because it gives CoreWeave's hardware a highly profitable second life. Older GPUs coming off long-term training contracts don't just sit idle in a rack. They get redeployed into this managed inference rocket ship to serve everyday AI queries. It generates incredibly high-margin, sticky revenue from enterprise clients who just want the final output, not the raw compute power.
Furthermore, they are actively fortifying the foundation by diversifying away from just pure GPU compute. CoreWeave is now generating over $400 million in annual recurring revenue from margin-accretive non-GPU services. We're talking storage, CPU infrastructure, and networking. As enterprise customers try to consolidate their cloud spend, they don't want to just buy GPUs from one guy and storage from another. They are paying CoreWeave to host their entire tech stack. This provides massive structural support. It expands the customer wallet share and drives overall platform margins way higher, which beautifully insulates them from the volatility of the next-generation silicon cycle.
To capture this much broader enterprise market, CoreWeave is drastically expanding its contract flexibility. Traditionally, this industry relies on very rigid 5-year take-or-pay commitments just to satisfy the cautious lenders and underwrite the debt. But with the recent closing of their highly innovative DDTL 5.5 financing facility, CoreWeave suddenly unlocked the ability to finance shorter duration contracts. And that is an absolute game changer for enterprise adoption. It allows them to secure traditional 2 to 3 year commitments, which is exactly what enterprise customers prefer. This de-risks the pipeline, greatly reduces friction in the sales cycle, and often allows them to capture even higher margins on shorter terms, pulling in a whole new, massive demographic of Fortune 500 clients.
Which leads us directly to Section 4, the final structural verdict.
So we have inspected the explosive growth engine, we've applied maximum hydraulic pressure to the debt load, and we've examined those flexible enterprise joints. From the lead analyst perspective, the numbers simply speak for themselves. Management has laid out upgraded, forged-in-fire guidance for FY 2026. They've raised revenue estimates to between $12.4 and $13.2 billion. They've lifted adjusted operating income to a massive range of $960 million to $1.15 billion. Yes, the Capex is incredibly heavy at $35 to $39 billion, there's no denying that, but it is absolutely necessary to hit that monumental exit run rate revenue target of $18.5 to $19.5 billion. Think about that for a second. Exiting 2026 at nearly a $20 billion annualized pace. The momentum here is practically unstoppable. The pricing power is fully intact, the margins are inflecting upward aggressively, and the capacity is completely sold out.
But the market skeptic perspective must leave you with a final, very serious warning. Do not let the top-line hypergrowth completely blind you to the foundational cracks. The biggest remaining risks are still the brutal capital intensity and the massive looming financing burden hanging over this entire operation. When a company expects nearly $1 billion in interest expense in a single quarter, their margin for error is essentially zero. The $104 billion backlog looks incredibly impressive on paper, sure, but a simple supply chain hiccup, a delay in power delivery to a key data center, or even a slight cooling in enterprise AI spending could turn this highly leveraged infrastructure into a very, very heavy anchor for your portfolio.
So we leave you with this final, crucial question to forge your own thesis. Is CoreWeave a foundational AI infrastructure pillar boasting unbreakable demand, or is the pure leverage risk simply too high for a conservative portfolio to bear? You have to weigh that $104 billion backlog against the $35 billion debt and decide what grade of metal you really want in your investments. That wraps up our deep dive explainer on CoreWeave's Q2 2026 earnings. Thank you so much for joining us in the Foundry today. Make sure to subscribe to Iron Financial, smash the like button, and let us know down in the comments, are you buying the hypergrowth or are you staying far away from the heavy debt? We will see you in the next analysis.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.